You are trapped right now, reading this, breathing, living what you think is a free life. But mathematically, structurally, legally, you cannot escape. This is not about distant empires or historical currencies. This is not about governments collapsing in other countries or economic theories in textbooks. This is about you. January 2026. And the trap that has been built around your life so carefully, so systematically, that you probably don't even realize you're inside it. Let me prove it with 3 numbers. The average American household carries approximately $145,000 in total debt. Mortgages, student loans, credit cards, auto loans, medical debt. This is not the top 1%. This is the median half of all households carry more than this. Half carry less, $145,000. If you have a credit card, and 68% of Americans do, the average interest rate you're paying is between 20 and 30% annually. Most people pay the minimum payment each month. Feels manageable, doesn't it? $200, $300. You can afford that. But here is what they don't tell you. If you have $10,000 in credit card debt at 22% interest and you pay only the minimum payment, it will take you over 30 years to clear that balance. 30 years. And you will pay more than $25,000 in interest alone. You will pay 2.5 times what you borrowed over 3 decades while thinking you're making progress. Thank you for watching. And if you went to college, if you did what every guidance counselor and parent told you was the path to success, you likely have student loan debt. The average is $30,000 for a bachelor's degree, $100,000 or more for graduate or professional degrees. And here is the special feature of student loans that makes them unique in American law. They cannot be discharged in bankruptcy. Every other kind of debt, credit cards, medical bills, even gambling debts, can be eliminated through bankruptcy if you truly cannot pay, but not student loans. They follow you to your grave. Wage garnishment is legal. Even your Social Security benefits in retirement can be seized to pay student loans you took out 50 years earlier. This is the individual trap. Now, let's zoom out. The United States national debt stands at $38.5 trillion and is growing by approximately $1 trillion every 90 days. That is $11 billion per day, $460 million per hour, $7.7 million per minute. In the time it takes you to listen to this sentence, the national debt has increased by over $100,000. Thanks for watching, and Talks and Plays the Plays Next Times of UN Agreed. And the next for watching, and with Master Day, another time. The annual interest cost on this debt, just the interest, not paying down the principal, has tripled in 6 years, from $345 billion in 2020 to approaching $1 trillion in 2026. That is more than the entire defense budget of the most powerful military in human history. More than Medicare. More than anything except Social Security. $1 trillion per year simply to service debt that can never realistically be repaid. Does everybody formant? And here's the part that connects your personal trap to the national trap to the global system. All money in the modern world is created through debt. With the exception of coins, which represent less than 1% of the money supply, every dollar in existence was created when someone, somewhere, went into debt. Banks create money by making loans. The Federal Reserve creates money by purchasing government bonds. When debts are repaid, that money is destroyed and disappears from the system. Thanks for watching, and I think this videos know, and the foundations of that's videos. This means something extraordinary and terrifying. If everyone in America paid off all their debts simultaneously, every mortgage, every credit card, every student loan, every car payment, and if the government paid off all bondholders, the supply of U.S. dollars would be virtually extinguished. The money would cease to exist. The system requires perpetual debt to function. It is not a flaw. It is the foundation. So when I say you are trapped, I do not mean you made bad choices. I do not mean you are financially irresponsible. I mean the system within which you exist was designed intentionally or through evolutionary incentive structures to ensure that most people remain in debt most of their lives. Because without that debt, the money supply collapses. The question this raises is simple and profound. Who built this system? Was it accident or design? And why, in 2025 and 2026, is the trap closing tighter than at any point in history? The answers are documented. The architects are identifiable. The mechanisms are visible once you know where to look. And what you will discover is that they, the Federal Reserve created in 1913, the commercial banking cartel, the credit card industry that targeted college students in the 1992s and 2000s, the political system that made student loans non-dischargeable in bankruptcy, the global financial architecture that traps developing nations in refinancing cycles did not create separate traps. They created one integrated system operating at individual, national, and global levels simultaneously. A system designed, whether consciously or through emergent incentives, to create debt that mathematically cannot be fully repaid. A system where your escape requires someone else to stay trapped. A system that is now, in January 2026, approaching the breaking point. This is not conspiracy theory. This is documented mechanism. And by the end of this, you will see it clearly. The Federal Reserve, the foundation of the trap. On November 22nd, 1913, the United States Congress passed the Federal Reserve Act, creating a central banking system unlike anything that had existed before in American history. The official story is that the Federal Reserve was designed to prevent bank panics, stabilize the currency, and manage the economy. The reality is more complex and far more consequential. The Federal Reserve is not a government agency. It is a private banking cartel with government blessing. The 12 regional Federal Reserve banks are owned by private commercial banks. The Board of Governors is appointed by the President and confirmed by the Senate, but the Fed operates independently and cannot be audited in full by Congress. What the Federal Reserve did, what it was designed to do, was fundamentally change the nature of money in America. Before 1913, money was backed by gold or silver. The paper currency represented a claim on physical precious metal. After 1913, and especially after 1971 when President Nixon severed the last tie to gold, American money became pure fiat currency paper backed by nothing except the promise of the government and the mechanism of debt. Here is how debt-based money creation works, and why it is the foundation of the trap. The Federal Reserve creates money out of nothing by purchasing government bonds, treasury securities issued by the U.S. government to finance deficit spending. When the Fed buys a $1 billion treasury bond, it credits the government's account with $1 billion that did not exist a moment before. The government spends that money into the economy. That money becomes bank deposits, and those bank deposits become the basis for commercial banks to create even more money through lending. Commercial banks operate under fractional reserve banking. They are required to hold only about 10% of deposits as reserves. The other 90% can be lent out. When a bank makes a $100,000 mortgage loan, it does not transfer $100,000 from some vault. It creates $100,000 by typing numbers into a computer. The borrower receives the money, spends it, and that money gets deposited in another bank, which can then lend 90% of it again. $100,000 in initial reserves can generate close to $1 million in the money supply through this multiplier effect. But here is the crucial point. All of that money was created through debt. The Federal Reserve's purchase of government bonds, the bank's creation of loans, all of it. And when loans are repaid, that money is destroyed. The dollars cease to exist. They are removed from the money supply. This creates an impossible mathematical situation. If everyone tried to pay off all their debts simultaneously, the money supply would collapse. There would not be enough dollars in existence to pay back all the principal plus interest, because the interest was never created. Only the principal enters the money supply when a loan is made. The interest must come from someone else's loan. It is a game of musical chairs where there are always fewer chairs than players. Well, that was really rating in the Stanger's consterie. Edward Griffin, author of The Creature from Jekyll Island, described it this way. With the exception of coins, all United States money is now created out of debt. This is not metaphor. It is literal. Every dollar in your wallet, every digit in your bank account, represents someone's obligation to pay back a loan. Your asset is someone else's liability, and the system requires that most of those liabilities never be fully repaid, because if they were, the assets would vanish. Thank you for watching. The Federal Reserve was not designed maliciously to enslave the population, but it was designed by bankers to serve banking interests. And the inevitable consequence of a debt-based monetary system is perpetual debt. It is not a bug. It is the architecture. The commercial banking system, too big to fail. The second layer of the trap is the commercial banking system, which has evolved over the past century into something more powerful than most governments. In 2008, the world discovered what too big to fail meant. Lehman Brothers, the fourth largest investment bank in America, collapsed in September 2008. Within days, global financial markets were in freefall. Credit froze. Banks stopped lending to each other because nobody knew who would collapse next. The entire system came within hours of total breakdown. The U.S. Government responded with the largest bailout in history. $700 billion in the TARP program. Trillions more in Federal Reserve emergency lending facilities, purchasing toxic assets, and guaranteeing bank debts. Banks that had gambled recklessly creating complex mortgage-backed securities, packaging bad loans with good ones, selling them as safe investments were rescued. The shareholders were mostly protected. The executives kept their jobs and bonuses, and the system was preserved. We wanted the stated not to Company 16-1. If you not to the dectos in the dect of the day-as. What did the banks learn from this? They learned that they could take unlimited risks because the government would always step in to prevent their failure. Privatize profits during good times. Socialize losses during bad times. And after 2008, the largest banks became even larger through consolidation and acquisition of failed competitors. This creates a trap at the national level. The government cannot allow major banks to fail because the consequences would be catastrophic. Millions of depositors would lose their savings. Credit would evaporate. The economy would collapse. So banks operate with an implicit guarantee, and that guarantee encourages even more reckless behavior. But there is a personal trap here too. Banks control the creation of money through lending decisions. In boom times, banks lend freely. Credit is easy. People buy homes, start businesses, expand. The economy grows. But in recessions, banks stop lending. They tighten standards, they hoard reserves. And because money is created through lending, when banks stop lending, the money supply contracts. The recession deepens. Unemployment rises. And more borrowers default, which makes banks even more cautious, which contracts lending further. It is a death spiral. The individual cannot escape this. When banks are lending, you are encouraged, practically forced to borrow, low interest rates. Easy approval. Everyone tells you it is the smart move. When banks stop lending, you cannot get credit even if you desperately need it. Your fate is tied to decisions made in boardrooms you will never enter, by people who do not know you exist. The credit card industry, the campus pipeline. The third layer of the trap is the credit card industry, which perfected a particular technique in the 1990s and 2000s, targeting college students. Picture a college campus in 2005. It is the first week of the fall semester. 18-year-olds are walking to classes, figuring out their schedules, trying to remember where the library is. And scattered across the campus are tables staffed by friendly representatives from credit card companies. They are offering free t-shirts, free pizza, free coolers with the school logo. All you have to do is fill out a simple application. Now we're running. Thanks for watching. Thanks for watching and stating subscribe. 18-year-olds, many of whom have never had a bank account, are being offered credit cards with $5,000 limits. No income verification, no financial literacy requirement, just a signature. The credit card companies knew exactly what they were doing. They were creating customers for life. Here is why it worked. An 18-year-old college student has no experience with compound interest. They see a credit card as money I can use now and pay back later. They do not understand that a 22% annual interest rate means that a $5,000 balance, if only minimum payments are made, will take decades to pay off and cost over $12,000 in interest. The companies were betting on exactly this ignorance. They were betting that most students would carry balances, pay minimums, and become long-term profit centers. And they were right. By the time students graduated, they had not only student loan debt, but also credit card debt, 2 traps instead of 1. In 2009, Congress passed the Credit Card Act, which was supposed to fix this problem. The law prohibited credit card companies from issuing cards to anyone under 21 unless they had a cosigner or could demonstrate independent income. This was marketed as protecting young people. But look at what actually happened. The trap did not disappear. It shifted. Now, parents had to cosign for their children's credit cards. The debt obligation moved from the student alone to the family unit. If the student could not pay, the parents were liable. The trap expanded rather than contracted. And for students over 21, nothing changed. They could still get credit cards easily. And the fundamental problem that credit cards charge 20 to 30% interest rates on unsecured debt, and most people do not understand compound interest, remained untouched. Today, the average American household carries over $8,000 in credit card debt. For those who carry balances month to month, it is over $16,000. At 22% interest, the minimum payment on $16,000 is approximately $400 per month. Of that $400, nearly $300 goes to interest. Only $100 reduces the principal. At that rate, it would take over 20 years to pay off the balance, assuming no additional charges are made. This is not accidental. Credit card companies design their minimum payment structures to maximize the time borrowers remain in debt. The longer you carry a balance, the more interest they collect. The system is optimized not for your financial health, but for their profit extraction. The student loan trap. Debt you cannot escape. The fourth layer is perhaps the most insidious. Student loans that cannot be discharged in bankruptcy. In 1976, Congress passed legislation making federal student loans non-dischargeable in bankruptcy. except under conditions of undue hardship, a standard so strict that it is almost never met. In 2005, the Bankruptcy Abuse Prevention and Consumer Protection Act extended this to private student loans as well. Now, whether your student loan is from the federal government or from a private bank, you cannot escape it through bankruptcy. This is unique in American law. Credit card debt can be discharged, medical debt can be discharged, even gambling debts and debts incurred through fraud can sometimes be discharged, but not student loans. They follow you until they are paid or until you die. And in some cases, if you have a cosigner, they follow your family even after your death. Why was this done? The official justification was that student loans were too easy to abuse. The concern was that people would get an expensive education, declare bankruptcy immediately after graduation, and walk away from the debt while keeping the degree. Making the debt non-dischargeable was supposed to protect the lending system. But consider what this actually created. It created a class of debt that borrowers have no legal escape from, no matter how dire their circumstances. You can lose your job, you can become disabled, you can face medical catastrophe, and your student loans remain. Wage garnishment is legal. Your tax refunds can be seized. Even your Social Security benefits in retirement can be garnished to pay student loans. They're accent. The Clearsley hymn and the buildings that, the duck down in 2022 75-4. And here is the truly diabolical part. This non-dischargeability gave lenders absolute confidence. They knew they would be repaid eventually, no matter what, so they had no incentive to be cautious about who they lent to or how much they lent. This, combined with federal guarantees on most student loans, meant that lenders faced essentially zero risk. What happened? Student loan debt exploded. Colleges and universities, knowing that students could borrow essentially unlimited amounts, raised tuition prices aggressively. From 1980 to 2020, college tuition increased by over 1,200%, far outpacing inflation, wage growth, and healthcare costs. Why? Because they could. Students could borrow whatever the school charged, and the debt could never be escaped. The result is a generation millennials and Gen Z entering adulthood with an average of $30,000 to $40,000 in debt for a bachelor's degree, and $100,000 or more for graduate degrees. They cannot buy homes because their debt-to-income ratios are too high for mortgage approval. They delay having children because they cannot afford them. They live with parents or roommates well into their 30s because they cannot save for a down payment. We haven't hill sense nighted of the torter, that it is nu ar marg ar dot edac, well, the torter it is nu ar dot edac, where they doing the clears the torter. And when they finally pay off their student loans in their 40s or 50s, their own children are approaching college age. The cycle repeats. Generational debt slavery, enshrined in law, impossible to escape through any legal mechanism. The global trap, developing nations in debt cycles. The fifth and final layer operates at the global level, trapping entire nations in debt cycles they cannot escape. According to UN Trade and Development Research from 2025, sustainable development financing is caught in a structural bind. Developing nations need massive investment in infrastructure, healthcare, education, and climate adaptation to achieve the Sustainable Development Goals. But the financing mechanisms available are overwhelmingly debt-based. Countries must borrow to develop, which creates debt service obligations that crowd out the very development spending the loans were meant to finance. And well, we have the down displays, that's not the rester. The report identifies 5 reinforcing mechanisms that create a debt trap for developing nations. First, the opportunity cost dilemma. Money spent on debt service cannot be spent on development. As debt burdens grow, more and more of national budgets go to creditors instead of to schools, hospitals, and infrastructure. This slows development, which reduces future growth, which makes the debt burden even heavier relative to the economy. Second, the credit rating penalty. When countries borrow to invest in development, credit rating agencies often downgrade them for excessive debt. But the downgrade makes future borrowing more expensive because lenders demand higher interest rates to compensate for perceived risk. So, the act of borrowing for development increases the cost of future development, creating a doom loop. Third, the temporal mismatch. Infrastructure projects generate benefits over 50 to 100 years. A highway, a power plant, a water system serves multiple generations. But development loans typically mature in 7 to 10 years. Countries must refinance constantly, facing rollover risk every few years. If interest rates rise or credit conditions tighten, refinancing becomes unaffordable, and countries face debt crises even when the original investment was sound. Where the rated it is, Hamas 2 of doon the man, with given man's the dooned is. Fourth, the risk amplification cycle. When one crisis hits a pandemic, a natural disaster, a commodity price shock, countries must borrow for emergency response. This increases debt levels, which makes the country more vulnerable to the next crisis, which requires more borrowing, which amplifies vulnerability further. Each shock leaves the nation weaker and more trapped. Fifth, the refinancing trap. Many developing nations borrowed in the 2010 seconds when interest rates were low. Those bonds are now maturing and must be refinanced at current rates, which are 2 or 3 times higher. African nations alone face over $100 billion in Eurobond maturities by 2025, and refinancing at current rates would double their interest costs, forcing cuts to essential services. The result is that countries trying to develop are trapped in a system where the very act of seeking development financing creates unsustainable debt burdens. They cannot develop without borrowing. They cannot sustain the borrowing while developing. It is a catch-22 by design. And when countries reach the breaking point, they turn to the International Monetary Fund or World Bank. These institutions provide emergency loans, but with strict conditions: austerity programs, privatization of state assets, cuts to social spending. The conditions often make social conditions worse while preserving creditor interests. The debt remains, but with external control added. This is they at the global level, not a conspiracy of individuals, but a system of institutions: central banks, commercial banks, credit agencies, international financial institutions, all following incentives that create and perpetuate debt traps. Understanding who built the trap is only the beginning. To see why escape is nearly impossible, you must understand the mechanism, how the trap operates at the individual level, the national level, and the global system simultaneously. Level 1. The individual debt trap, a lifetime of servitude. The individual debt trap operates in 5 distinct stages across a human lifetime. Each stage requires debt to progress to the next. Miss any stage through illness, job loss, or any other disruption, and you fall behind permanently because compound interest grows faster than you can catch up. Stage 1. Education debt, age 18 to 22. It begins the moment you decide to go to college. You are 18 years old. Everyone, parents, teachers, guidance counselors, society itself has told you that college is the path to success, that you need a degree to get a good job, that student loans are good debt because education is an investment in yourself. So you sign the promissory notes: $30,000, $50,000, $100,000 for graduate school. You do not fully understand compound interest. You do not realize that a 6% interest rate means your debt will double in 12 years if you do not pay it down. You just see the monthly payment estimate, $200, $400, and think, I can afford that once I have a job. Meanwhile, you have also acquired a credit card, either on your own if you are over 21, or with a parent as cosigner if you are younger. You use it for textbooks, for food when your meal plan runs out, for emergencies. The balance grows to $2,000, $3,000. You tell yourself you will pay it off after graduation. It's a plinder with Bregrepstein. The downlinet's the plinder with Bregrepstein. Stage 2. Lifestyle inflation, age 22 to 30. You graduate. You get your first job. Entry-level salary, $40,000 to $50,000 if you are lucky. You receive your first paycheck and discover how much disappears to taxes. Your take-home pay is perhaps 65% of your gross salary, $30,000 after taxes on a $45,000 salary. Now the bills arrive. Student loan payment, $350 per month. That is $4,200 per year. You need a car to get to work. Public transit does not reach your job or does not exist where you live. Car payment, $400 per month. Insurance, $150 per month. That is $6,600 per year for transportation. You need a place to live. You cannot afford to buy, you do not have a down payment, and your debt-to-income ratio is too high for a mortgage. So you rent $1,200 per month for a one-bedroom apartment in a city where jobs exist, $14,400 per year. Let's add it up. $30,000 take-home pay, minus $4,200 for student loans, minus $6,600 for car and insurance, minus $14,400 for rent. That leaves $9,800. Divide by 12, $816 per month for everything else. Food, utilities, internet, phone. Clothing, healthcare, copays and deductibles, entertainment, savings. There is no buffer. Any unexpected expense, car repair, medical bill, family emergency goes on the credit card. And remember, you already graduated with $3,000 on that credit card. At 22% interest, you are paying $55 per month in interest alone on that balance. If you pay only the minimum, the balance never really decreases. This is the trap closing. You are working full-time. You are doing everything society told you to do. And you cannot get ahead. You are trapped in place, servicing debt, unable to save. Stage 3. The housing trap, age 30 to 45. Eventually, perhaps in your early 30s, you manage to save enough for a down payment on a house. Maybe 5% down on a $300,000 home, $15,000. More likely, you receive help from family. Parents who want you to achieve stability contribute $10,000 or $20,000. You get a mortgage. 30 years at 4 or 5% interest. Your monthly payment is $1,600 for principal and interest. Add property taxes at perhaps $300 per month. Add homeowner's insurance at $150 per month. Add maintenance, a new roof eventually, a new HVAC system, plumbing repairs averaging perhaps $200 per month over the long term. Your total housing cost is $2,250 per month. That is $27,000 per year. Yes, you are building equity. After 10 years of payments, perhaps $70,000 of your $300,000 mortgage is paid down. But you have also paid $140,000 in total payments, meaning $70,000 went to interest and other costs. You have paid for the house twice just to own 1/3 of it. And you are locked in. You cannot easily move to pursue better job opportunities, because selling involves realtor commissions and closing costs. You cannot escape the property taxes, which tend to increase faster than inflation. You are tied to this asset for 3 decades. This is what they call the American dream. It is actually the housing trap. You are renting from the bank for 30 years. And if you miss payments, the bank takes everything, both the house and all the money you have already paid. Stage 4, family expansion and the sandwich generation, age 35 to 55. If you have children, the trap multiplies. The USDA estimates it costs over $250,000 to raise a child to age 18, and that does not include college. Food, clothing, healthcare, childcare, extracurricular activities. It is an enormous financial burden on top of your existing debt. And now your children are approaching college age. You want better for them than you had. You do not want them buried in student debt. But you still have your own student loans you have been paying for 15 years and still owe $30,000 because of interest accumulation and income-based deferments during hard times. So you do what parents do. You co-sign their student loans, you take out Parent Plus loans, you sacrifice your own retirement savings to help with their tuition. And suddenly, in your late 40s or early 50s, you are carrying your original debt, your mortgage, and now your children's education debt as well. Meanwhile, your parents are aging. They need help. Long-term care is expensive, thousands of dollars per month. Medicare does not cover it. Their retirement savings are insufficient. And you, trapped in your own debt, are now supporting both your children and your parents simultaneously. This is the sandwich generation, and it is expanding. There is no room to breathe, no room to save for your own retirement. Every dollar is spoken for before it arrives. Stage 5, retirement impossibility, age 55 and beyond. You are now in your 60s. Your student loans are finally paid off. It took 35 years. Your mortgage is almost paid off. You refinanced once during low rates in the 2010 seconds, resetting the 30-year clock, so you still have 5 years to go. Your children have graduated, though some are living at home again because they cannot afford rent in the current economy. You look at your retirement savings. If you are disciplined and lucky, perhaps you have $300,000 in your 401. Sounds like a lot. But financial advisors say you need 8 to 10 times your final salary to retire comfortably. If you were earning $75,000, you need $600,000 to $750,000. You have less than half of that. Social Security will provide perhaps $2,000 per month. Your retirement account, using the 4% safe withdrawal rule, can provide another $1,000 per month. $3,000 total. But your healthcare costs in retirement, even with Medicare, average over $700 per month out of pocket. Your property taxes are still $400 per month. That leaves less than $2,000 for food, utilities, maintenance, and everything else. You realize you cannot afford to retire, so you work into your late 60s, your 70s if your health holds. Not because you love your job, not because you are passionate about your work, but because the alternative is poverty. And then, inevitably, come medical expenses. A hospital stay, surgery, chronic conditions requiring expensive medications. Medicare Part D has a coverage gap, the donut hole. Supplemental insurance helps, but does not cover everything. Medical debt accumulates, you are 80 years old and falling back into debt again. This is the lifetime trap, 5 stages, 60 years, and at no point was there ever enough breathing room to truly escape. Each stage required debt to access. Each stage prevented accumulation of sufficient wealth to break free. The system extracted value from your labor for your entire life and left you, at the end, with just enough to survive, but never thrive. Level 2. The National Debt Trap, a government in paralysis. The national debt trap mirrors the individual trap, but operates at vastly larger scale. Stage 1 is emergency justification. Every major increase in U.S. national debt has come during a crisis, World War II, the 2001 terrorist attacks and subsequent wars, the 2008 financial crisis, the 2020 pandemic. Each time, the borrowing is presented as temporary just until we get through this emergency. But the debt never decreases significantly after the crisis passes. During World War II, debt reached 120% of GDP. It declined gradually over 30 years as the economy grew faster than the debt. But starting in the 1980 seconds, the pattern reversed. Debt began growing faster than the economy in both good times and bad. The 2008 crisis added $8 trillion. The 2020 pandemic added $6 trillion. And now, in 2026, the debt sits at $38.5 trillion, 122% of GDP, and is growing by $1 trillion every 90 days. Stage 2 is the interest cost spiral. In 2020, the federal government paid $345 billion in interest on the national debt. Interest rates were at historic lows, many bonds issued at under 2%. But as the Federal Reserve raised rates to fight inflation in 2022 through 2025, new bonds had to be issued at 4, 5, even 6%. And as old bonds matured, they were refinanced at these higher rates. By 2026, annual interest costs approach $1 trillion, and the trajectory is accelerating. If rates remain at 4 to 5% and the debt continues growing at current pace, interest costs will exceed $1.5 trillion annually by 2030. At that point, interest will consume approximately 20% of all federal tax revenue. This is approaching the 40% threshold that Spain reached in 1598, the level at which debt servicing crowds out all other government functions. Stage 3 is fiscal space elimination. Currently, mandatory spending, Social Security, Medicare, Medicaid, and now interest on the debt consumes roughly 75% of the federal budget. That leaves 25% for everything else: defense, veterans benefits, education, infrastructure, scientific research, national parks, federal law enforcement, diplomacy, everything. As interest costs continue rising, and as Social Security and Medicare obligations grow automatically with the aging population, mandatory spending will approach 85 or 90% of the budget. There will be no fiscal space for investment, no money to address climate change, rebuild crumbling infrastructure, or invest in new industries. The government will become a machine that collects taxes to pay the elderly and creditors, with nothing left for the future. Stage 4 is political paralysis. To stabilize the debt-to-GDP ratio, the federal government would need to run sustained budget surpluses, spending less than it collects in taxes. But this requires either massive spending cuts or massive tax increases, or both. Thanks for watching, and if you get newsing, to the 69er. Spending cuts are politically impossible. You cannot cut Social Security without losing the senior vote, the most reliable voting bloc in America. You cannot cut Medicare for the same reason. You cannot cut defense because you are labeled weak on national security. You cannot cut interest payments without defaulting. What remains is less than 1/4 of the budget, and cutting it entirely still leaves trillion-dollar deficits. Tax increases face similar obstacles. The increases needed to close a trillion-dollar annual deficit would require raising average tax rates by perhaps 30 to 40%. Working-class voters cannot afford that. Wealthy voters have political influence to prevent it, and corporations can shift profits overseas or threaten to relocate jobs. So neither party actually addresses the debt. Republicans cut taxes and keep spending. Democrats raise spending and raise taxes inadequately. Both parties vote for massive bills that increase deficits. The system is structurally incapable of self-correction through normal democratic processes. Stage 5 is the choice of catastrophes. Eventually, and the timeline is approaching quickly, the U.S. will face 3 options, all bad. Option 1, sustained inflation. Allow 4 to 6% inflation for 10 to 15 years. This erodes the real value of the debt. A $30 trillion debt today becomes $18 trillion in purchasing power after 15 years of 5% inflation. But this also erodes the purchasing power of everyone's savings, wages, and retirement funds. It is a slow confiscation of wealth from the population to reduce government debt burden. Option 2, restructuring. Force creditors to accept losses. Convert old treasury bonds to new ones at disadvantageous rates, perhaps 70 cents on the dollar. Extend maturities. Lower interest rates. This is a soft default, and it would end dollar reserve currency status immediately. Foreign holders of U.S. debt would never trust America again. Option 3, collapse. If neither inflation nor restructuring happens in time, the debt crosses thresholds where interest costs become unpayable even by printing money. Treasury auctions fail. The government cannot borrow. It cannot pay obligations. Federal services break down. the currency crashes, social order strains. Thanks for watching. However, the trap at the national level is that waiting makes all three options worse, but acting requires political courage that democratic systems rarely produce. Level 3. The global system trap. Impossible choices for developing nations. At the global level, the trap operates through the debt architecture that governs developing nations. These countries face an impossible trilemma. They need to develop their economies, but development requires investment, and investment financing is structured as debt that prevents development. Consider infrastructure. A developing nation needs to build a power grid, a transportation network, clean water systems. These projects cost billions. The benefits span 50 to 100 years. Future generations will use the infrastructure and gain economic value from it. But the financing available World Bank loans, private bond markets, bilateral lender agreements matures in 7 to 10 years on average. This creates a temporal mismatch. The country must start repaying long before the economic benefits materialize. And worse, it must refinance repeatedly. Every 7 years, the country faces rollover risk. If global interest rates have risen, or if the country's credit rating has declined, refinancing becomes dramatically more expensive or impossible. Thanks for watching. With a tooth out subitalize, the credit rating agencies create a doom loop. A country borrows for development. The rating agency says this country has too much debt and downgrades its credit rating. The downgrade makes future borrowing more expensive. Higher borrowing costs mean more debt service. More debt service means less money for development. Less development means slower economic growth. Slower growth makes the debt to GDP ratio worse. The rating agency downgrades again. This is not hypothetical. In 2025, African nations face over $100 billion in Eurobond maturities, bonds issued in the 2010 seconds when interest rates were 5 to 6%. Now those bonds must be refinanced at 10 to 12% or higher, because many African nations have been downgraded. The interest burden will more than double, forcing cuts to healthcare, education, and infrastructure, the very investments that were supposed to enable growth. After and extremes, the stations en reside en de sturd, where after Ada Veldum, the Compte now into the storing de stage. The result is what the UN report calls a debt trap for sustainable development. Countries cannot achieve the sustainable development goals without massive investment. They cannot finance the investment without debt. The debt makes the goals unachievable by crowding out the investment. It is a closed loop with no exit. And when countries reach breaking points, unable to service debt, unable to access markets, they turn to the IMF. The IMF provides emergency loans. But the conditions attached to austerity programs, privatization, currency devaluation, trade liberalization often make social conditions worse. Governments cut food subsidies, education budgets, healthcare spending, unemployment rises, poverty increases. Social unrest follows. And through it all, the debt service continues, often with IMF loans simply refinancing old debt at the expense of development. This is the global trap. Development financing structured as debt that prevents development. Repayment schedules that create refinancing risk every few years. Credit ratings that penalize borrowing for investment. And international institutions that impose austerity as the solution. The system is designed, whether intentionally or through emergent structures, to keep developing nations in permanent debt dependency. Understanding the mechanism reveals why the title of this analysis is accurate. You can never escape. This is not hyperbole. It is mathematical reality, structural constraint, and systemic design. Mathematical impossibility at the individual level. Start with the simplest math. Compound interest grows exponentially. Income grows linearly at best. If you have $50,000 in student loan debt at 6% interest, and you earn $45,000 per year with 3% annual raises, here is what happens over a decade. Year 1, debt is $50,000 at 6%, accruing $3,000 in interest. Your income is $45,000, growing to $46,350. If you pay only interest, your debt never decreases. To make progress, you must pay more than $3,000 per year. Let's say you pay $5,466 per month. After 10 years of $5,000 annual payments, you will have paid $50,000 total and still owe $29,000. The interest accumulated faster than your payments reduced principal. Meanwhile, your income grew from $45,000 to $60,000 over that decade, a 33% increase. But your debt, despite $50,000 in payments, only decreased 42%. And that assumes no other debt. If you also have credit card debt at 22% and a car loan at 7%, the math becomes even worse. For most Americans, income growth does not exceed debt growth. Real median wage growth has been approximately 2% annually for the past 30 years, but college tuition has grown at 6%. Healthcare costs at 5%. Housing costs in major metros at 4 to 7%. Debt service obligations grow faster than income. The gap widens every year. And here is the truly impossible part. If you fall behind, if you lose your job for 6 months, if you have a medical emergency, if your car breaks down and needs $5,000 in repairs, you cannot catch up. Compound interest continues accumulating while you are in crisis. The debt grows while your income disappears or shrinks. Missing 6 months of payments can set you back years or even decades. Structural barriers that prevent escape. Even if you have the income to theoretically pay down debt, structural barriers trap you in the system. The first is credit score coercion. Modern American life requires a good credit score for nearly everything. Renting an apartment, getting utilities turned on. Some employers check credit as part of hiring. Insurance companies use credit scores to set rates. A bad credit score can make you unemployable, uninsurable, and unable to access housing. But maintaining a good credit score requires participating in the debt system. You must use credit cards and loans. A person who never borrows, who lives entirely on cash and savings, will have no credit history, which is treated as equivalent to bad credit. So you are forced to use debt to maintain the score that allows you to function in society. You cannot opt out without severe penalties. The second barrier is the non-dischargeability of student loans. As we discussed, student loans cannot be eliminated through bankruptcy except under nearly impossible conditions. This means that if your economic situation becomes truly catastrophic, you lose your job permanently, you become disabled, you face overwhelming medical costs, you can discharge credit cards and medical debt through bankruptcy, but student loans remain. And the penalties for non-payment of student loans are severe. The government can garnish your wages without a court order. It can seize your tax refunds. It can garnish your Social Security benefits in retirement, taking money from a 70-year-old to pay for a degree from 50 years earlier. There is no statute of limitations. The debt never dies. The third barrier is asset price inflation. Housing prices, stock prices, and other assets have been rising faster than wages for decades. In 1980, the median home price was approximately 3 times median household income. Today, it is 6 to 7 times median income. A person earning $50,000 per year could comfortably afford a $150,000 home in 1980. Today, that same relative income means they should buy a $350,000 home, but they only earn $60,000, not enough for the proportional jump. So to buy assets that build wealth, homes, stocks, businesses, you must go into debt. You cannot save fast enough to keep pace with appreciation. The assets rise in value faster than you can accumulate savings to purchase them. Debt becomes the only access point. And once you take on debt to buy an appreciating asset, you are locked in. You must service the debt, which prevents you from saving for other assets, which keeps you in the debt cycle. Thanks for watching. Thanks for watching in Nasir Times Taman. Political and systemic impossibility. At the national and global levels, escape is impossible due to political structures and systemic incentives. The democratic debt trap works like this. Voters want low taxes and high government benefits. No politician who tells the truth, we must cut Social Security and Medicare by 30% and raise taxes by 40% to stabilize the debt, will win an election. Politicians who promise easy solutions, we can cut waste and fraud, or we can tax only the very rich, win elections, even though the math does not work. This creates a ratchet effect. Benefits can be increased easily because voters like benefits. Taxes can be cut easily because voters like tax cuts. But benefits cannot be cut and taxes cannot be raised because voters punish politicians who try. So debt is the only solution. Borrow to pay for benefits without raising taxes. Let future voters deal with the consequences. But future voters, when they become present voters, face the same incentives. They do not want their benefits cut either. So they also borrow. Every generation passes the burden forward, expecting the next to solve it. But the next generation cannot solve it without imposing pain on themselves, which they will not do. The system locks in debt accumulation. At the global level, the trap is maintained by institutional structures. The IMF, World Bank, and major central banks are controlled by creditor nations the U.S., Europe, Japan. These institutions set the rules for development financing, and the rules favor creditors. Loans must be repaid. Austerity must be imposed when countries struggle. Debt restructuring is rare and comes with punishing conditions. Debtor nations cannot escape because they need access to capital markets, and access requires following creditor rules. If a country defaults or restructures without creditor approval, it is frozen out of international finance for years or decades. It cannot borrow for any purpose, even emergencies. So countries accept unsustainable debt terms rather than face exclusion. Why never escape is nearly accurate. Can individuals escape? Yes, but rarely. It requires some combination of asterisk, very high income, top 10% or better, asterisk, family wealth or inheritance, asterisk, extreme frugality sustained for decades, asterisk, geographic arbitrage earn, developed world income, live in developing world costs, asterisk, entrepreneurial success, building equity instead of trading time for wages, asterisk, luck, no major health crises, no family emergencies, no economic recessions during critical years. For the median American median income, median debt, median circumstances escape is nearly impossible. The math does not work. Compound interest exceeds income growth. Structural barriers prevent opting out. And any disruption pushes you backward faster than you can move forward. Can nations escape? History says no. No modern democracy has ever paid down massive debt through sustained surpluses. Debt reduction has come through war, which destroys debt, but also destroys nations, through inflation, which is slow default, or through explicit default, which is catastrophic. Growth booms can reduce debt to GDP ratios, but those are accidental, not policy engineered. Can the global system escape? Not without complete restructuring. The system requires perpetual debt to function. If all debt were repaid, the money supply would collapse. The trap is not a flaw in the system. It is the system. Escape would require building a completely different monetary architecture, something not based on debt creation. And the institutions and individuals who benefit from the current system will fight any such change. So yes, you can never escape is nearly accurate for most people, most nations, and the system as a whole. The rare exceptions, individuals who break free, nations that restructure successfully prove the rule by their rarity. The trap is real, the mathematics are locked in, and the system is designed to perpetuate itself. If escape is impossible, what comes next? And more importantly, how do you survive it? The trap will not continue forever. Systems that are mathematically unsustainable do not sustain. Something will break. The only questions are when, how, and what emerges from the wreckage. The three probable endgames: Endgame 1, the slow grind. Probability 60%. This is the most likely outcome because it is the path of least resistance. No dramatic crisis. No sudden collapse. Just a gradual decline in living standards spread over 10 to 15 years. The mechanism is sustained inflation at 4 to 7% annually. Not high enough to trigger panic or hyperinflation. Not low enough to preserve purchasing power. Just enough to erode debt in real terms while maintaining the appearance of normalcy. The government does not explicitly default. It pays all obligations in full, in dollars, but those dollars buy progressively less. A retiree receiving $3,000 per month in Social Security and pension income finds that after 10 years of 5% inflation, that $3,000 has the purchasing power of $1,800 in today's terms. They did not receive a cut, but they are 39% poorer. Meanwhile, asset prices, stocks, real estate, gold rise with inflation or faster. People who own assets benefit. People who rely on wages and savings suffer. The wealth gap widens dramatically. The dollar gradually loses reserve currency status, declining from 58% of global reserves in 2024 to perhaps 35% by 2040. This is managed decline, not catastrophic loss, but steady erosion. Trade increasingly occurs in yuan, euros, and regional currencies. The exorbitant privilege of printing the global reserve currency fades. So I was recent, as expected AARC 2002. For the average American, this means asterisk. Real wages decline 30 to 40% over 15 years. Asterisk. Retirement becomes impossible until age 75. Asterisk. Homeownership transitions from norm to privilege. Asterisk. Multi-generational households become necessity, not choice. Asterisk. The American dream becomes historical memory. The nation remains powerful, but not exceptional. A normal, developed country with normal constraints. The middle class shrinks to 30 to 40% of the population, down from 55% in 2000. Social mobility declines. Political instability increases. But the system does not collapse. It just becomes permanently worse. This is the Japanese model applied to America. Stable poverty, order without prosperity. The trap remains closed, but life continues within it. Texter nexters the send of the sense of an descender. The nexter nexters the particle of clans Y. Endgame 2. The crisis reset. Probability 25%. This scenario requires a triggering event that forces sudden action. A major war with China over Taiwan. A a global financial crisis triggered by debt defaults in multiple nations simultaneously. The successful launch of a BRICS currency backed by gold that gains immediate adoption by major oil exporters. A sustained inflation breakout above 10% that the Federal Reserve cannot control. The trigger creates panic. Treasury auctions fail, not enough buyers at acceptable rates. The dollar index crashes, losing 20% of value in weeks. Capital flight accelerates. Wealthy individuals and institutions move money offshore. Foreign central banks dump dollar reserves. The government responds with emergency measures previously considered unthinkable. A central bank digital currency is rolled out within months. All bank accounts are required to convert. The CBDC allows the government to track every transaction, impose negative interest rates to discourage saving, and potentially program money to expire if not spent, quickly forcing consumption. Capital controls are enacted. Limits on international wire transfers. Restrictions on cryptocurrency purchases. Taxes on foreign asset holdings. Americans are effectively locked into the dollar system with limited ability to diversify internationally. Wealth taxes are imposed, 5 to 10% annually on assets above $1 million. This is sold as making the wealthy pay their fair share, but functions as partial confiscation to stabilize government finances. Pension funds and insurance companies are required to purchase treasury bonds at below market rates. This is presented as patriotic duty, but amounts to forced lending to prop up failed bond auctions. And finally, the reset itself. Old dollars are converted to new dollars at a disadvantageous exchange rate. Perhaps 10 old dollars equals 7 new dollars. This is a 30% haircut disguised as currency reform. Debts are redenominated in new dollars, effectively reducing the government's debt burden by 30%. But savings, wages, and pensions are also reduced by 30%. And this was live in the 70 walks the governors roof. Social Security and Medicare are reformed benefits cut 20 to 30% through means testing, raised retirement ages, and modified inflation calculations. The government cannot afford current promises, so promises are broken. This scenario compresses what would have taken 10 years of slow grind into 18 to 24 months of crisis and restructuring. The pain is intense, but concentrated. After 3 years of chaos, a new equilibrium is reached. The standard of living has fallen 40 to 60% from pre-crisis levels. Trust in institutions is shattered, but the system stabilizes and continues. This is the French Revolution model applied to modern finance, not guillotines but digital confiscation and forced restructuring. The old system dies, a new system emerges. And most people are poorer in the new system than they were in the old. Thanks for watching. Workley, Anawachin, Ender. Endgame 3. The catastrophic collapse. Probability 15%. This is the nightmare scenario. Unlikely precisely because it is so catastrophic that every powerful institution will fight desperately to prevent it. Multiple low-probability events converge simultaneously. War with China disrupts global trade and forces massive military spending. The BRICS currency launches and gains immediate adoption by Saudi Arabia, UAE, and other oil producers. Treasury auction fails spectacularly. Domestic bank runs begin as depositors lose confidence. Supply chains break down due to dollar instability, making imports unaffordable. The dollar loses 50% of its value against other major currencies within 6 months. Hyperinflation begins 20% monthly inflation, which compounds to 800% annually. Import costs explode. Gasoline reaches $20 per gallon. Basic foods double in price every few months. The government cannot borrow at any rate. It cannot roll over maturing bonds. It faces a choice between explicit default or printing unlimited money. It chooses printing. The Federal Reserve creates trillions in days. This accelerates inflation further. Federal services begin breaking down. Social Security checks arrive but buy nothing. Medicare reimbursements cannot cover costs, so healthcare providers stop accepting it. Federal employees quit because their salaries are worthless. Tax collection collapses because nobody trusts the currency. Supply chains fragment. International trade becomes barter or gold-based because nobody accepts dollars. Domestic commerce shifts to alternative currencies, cryptocurrencies, foreign currencies, precious metals, even cigarettes and ammunition in some regions. Social order strains. Food shortages in cities dependent on long supply chains. Energy shortages as oil producers refuse dollars. Crime increases as police cannot be paid effectively. Political legitimacy collapses as the federal government proves unable to maintain basic functions. In the most extreme version, the federal system itself fractures. States begin making independent arrangements. Texas negotiates directly with oil producers. California with Asian trade partners. Florida with Latin America. The United States, as a unified nation-state, comes into question. This scenario is unlikely, perhaps 10 to 15% probability, because the catastrophe is so complete that every institution with power has incentive to prevent it. Military leadership, financial elites, political leaders across parties all would lose in total collapse. So, emergency measures, no matter how draconian, will be implemented before reaching this point. Endgame 2 becomes preferable to Endgame 3, even if Endgame 2 requires confiscation and restructuring. His that was now, we have the stater, in flight work, the individual survival playbook. You cannot escape the trap. The system is too large, too entrenched, but you can position yourself to survive and potentially thrive when the endgame arrives. Strategy 1. Asset diversification outside the trap. Hold 20 to 30% of liquid assets in hard stores of value that exist outside the debt-based monetary system. Gold and silver have preserved purchasing power through every currency crisis in history, from Rome in the 3rd century to Mexico in 1982 to Russia in 1998. Physical possession is crucial, not paper gold certificates, not gold ETFs, physical metal you can hold. Bitcoin and selected cryptocurrencies serve a similar function for the digital age assets that exist outside government control and cannot be printed into infinity. The risk is higher than precious metals, but the potential for preserving value during currency crises is significant. Productive, land, agricultural property that can generate food holds value regardless of currency fluctuations. You cannot eat gold, but land that grows food has intrinsic worth in any economic system. These are not investments in the traditional sense. They are insurance against monetary collapse. You hope you never need them. But if you do need them, they will be worth far more than dollars in a bank account. Strategy 2. The debt strategy reversal. Conventional wisdom says pay off all debt aggressively. But in an inflationary environment, which is the most likely endgame, this advice is backwards. If you have fixed-rate debt at low interest rates, inflation is your friend. A 30-year mortgage taken at 3% in 2020 becomes cheaper every year in real terms. If inflation runs at 5%, you are effectively earning 2% annually by holding that debt. The strategy is counterintuitive. Pay minimums on low-interest, fixed-rate debt. Direct all extra payments toward high-interest, variable-rate debt credit cards, adjustable-rate loans. The goal is to eliminate debt that adjusts with inflation while maintaining debt that gets eroded by inflation. This requires discipline and literacy. You must understand the difference between nominal and real interest rates. But executed correctly, this strategy allows inflation to work for you rather than against you. Strategy 3. Income diversification and portable skills. Single employer income is a single point of failure. If that job disappears, your income goes to zero. Develop multiple income streams, freelance work, side businesses, rental properties, dividend-producing investments. More importantly, develop skills that remain valuable regardless of economic system. Healthcare workers are needed in boom and bust. Skilled tradespeople, electricians, plumbers, welders cannot be outsourced and remain in demand. Technology skills that solve real problems have value across currencies and borders. The most portable skill is knowledge itself. Financial literacy, understanding how money is created, how inflation works, how to read balance sheets. Historical literacy, knowing how previous crises unfolded, provides pattern recognition for what comes next. These cannot be confiscated or inflated away. Strategy 4. Community building as economic infrastructure. When distant systems break down, local networks become survival mechanisms. The Romans, who survived the 3rd century crisis, had strong local community ties. The Soviets, who navigated the 1991 collapse, relied on family and neighborhood networks. Build relationships in your physical community. Skill sharing, resource pooling, and mutual aid networks become economic assets when formal systems fail. The person who can fix your car in exchange for you fixing their computer. The neighbor who grows vegetables you can buy or trade for. The local doctor who treats people for barter when insurance collapses. This is not prepper survivalism. It is practical resilience. Strong local ties provide economic cushioning that no amount of money in a bank, especially a potentially failing bank, can match. Strategy 5. Geographic and jurisdictional diversification. Do not concentrate all your assets, income, and future in one jurisdiction. If you have the means, maintain presence in multiple countries, bank accounts in multiple currencies, assets in multiple legal systems, the ability to relocate if one nation becomes uninhabitable economically or politically. For most people, full international diversification is unrealistic. But even modest steps help. Hold some euros or Swiss francs, maintain a passport from a second country if eligible through ancestry or naturalization, develop skills that would allow you to work remotely for companies in more stable nations. The principle is redundancy. If System A fails, you have System B. If currency A collapses, you have currency B. Concentration is vulnerability. Diversification is resilience. Strategy 6. Reduce dependency on the system. The more you need government services, corporate employment, and complex supply chains, the more vulnerable you are to systemic breakdown. Reduce dependencies where possible. Food. Even small-scale home food production container gardens. Backyard chickens reduces reliance on supply chains. Water security through filtration and storage. Energy independence, through solar or other renewables, reduces exposure to utility failures. Health. Prevention and fitness reduce healthcare dependency. Basic medical knowledge and supplies allow treatment of minor issues without accessing failing healthcare systems. This is not about becoming completely self-sufficient that is unrealistic for most. It is about reducing critical dependencies by 10, 20, 30%. That margin can be the difference between weathering a crisis and being destroyed by it. Strategy 7. The contrarian position. When everyone is doing the same thing, do the opposite. When everyone is borrowing and consuming, save and invest. When everyone is in stocks, hold some cash and gold. When everyone panics, stay calm because you prepared. When everyone is complacent, you prepare for what they are ignoring. This requires psychological strength. You will look foolish during good times. Friends and family will question why you are holding unproductive assets like gold when stocks are soaring, why you are renting when everyone is buying homes, why you are saving when everyone is spending. But when the crisis comes, contrarian positioning saves you. You have assets that gained value when everyone else has collapsed. You have liquidity when others are trapped. You have options when others have only desperation. Strategy 8. Knowledge as the ultimate portable wealth. Everything else can be taken. Assets can be confiscated, property can be taxed to worthlessness, bank accounts can be frozen, currencies can collapse, but knowledge remains. Understand the system you are trapped in. Read the Federal Reserve's own publications about how money is created. Study previous debt crises, Spain, France, Weimar, Germany, Latin America in the 1,980 seconds, Russia in 1998, Argentina in 2001. The patterns repeat. Knowing them allows you to see what is coming before others do. Learn practical skills, how to repair things, how to grow food, how to provide first aid, how to teach, how to build. Skills that would be valuable in any economy, from Stone Age to Space Age. Study philosophy and history. Why do systems fail? How do humans respond to crisis? What separates those who survive from those who do not? The answers are in history, and those who know history can navigate the present more effectively than those who do not. Knowledge cannot be inflated away. It cannot be confiscated. It cannot be taxed. It travels with you across borders, and it can be shared without being diminished. It is the ultimate form of wealth in uncertain times. The problem stories are deuce with durning action, and I would do 70 problems. The philosophical conclusion. We return to the question posed at the beginning. Was this designed, or did it evolve? The answer is both, and that makes it more insidious. Nobody sat in a room in 1913 and said, let us create a system to enslave humanity in perpetual debt. But the Federal Reserve Act created incentive structures that made perpetual debt inevitable. Banks profit from lending, so they lend to the maximum. Politicians profit from spending without raising taxes, so they borrow. Individuals are taught that debt is the path to prosperity, so they borrow for education, homes, consumption. Each decision is rational for the actor making it, but rational individual decisions created a collectively insane system. The trap built itself through millions of self-interested choices over 113 years. And now the trap is so large, so complex, that even its architects are trapped inside. The Federal Reserve cannot stop quantitative easing without crashing the markets it is responsible for stabilizing. Politicians cannot cut spending without losing elections they need to enact policy. Banks cannot stop lending without triggering recessions that destroy them. Individuals cannot opt out of credit scores and debt without severe life penalties that make modern existence nearly impossible. Everyone is trapped in a system nobody fully controls and nobody can safely dismantle. The title's claim, "They built a debt trap you can never escape," is accurate in its essentials. They built, yes, the Federal Reserve in 1913. The credit card industry targeting students in the 1,990 seconds, 2000s. Student loan non-dischargeability in 1976 to 2005. The global development finance architecture trapping nations. Debt trap. Yes, the system is mathematically structured to create perpetual debt that cannot be fully repaid. Money is debt. Repaying all debt would extinguish the money supply. Yes. The trap operates at individual, national, and global levels simultaneously. Your personal credit card debt, your nation's $38.5 trillion, developing countries' refinancing cycles, all manifestations of the same mechanism. Never escape. Mostly true. Escape is extremely difficult and requires privilege, luck, or extreme sacrifice. For the median person, in median circumstances, the mathematics do not allow escape. For nations, historical evidence shows no democracy has escaped massive debt through normal political processes. For the global system, escape would require complete redesign, which those benefiting from current arrangements will resist. The 2025 system, yes. The current iteration is tighter and more sophisticated than any previous version. Digital tracking, non-dischargeable debt categories. Global coordination of debt enforcement. The trap has evolved and strengthened over time. But here is the critical point. Saying the trap exists and escape is nearly impossible is not the same as saying resistance is futile or preparation is worthless. You cannot change the system. It is too large, too entrenched. Too many powerful interests depend on its continuation. But you can see it clearly, and seeing clearly allows you to navigate it more effectively than those who remain blind. Thanks for watching. You cannot prevent the endgame. The mathematics are locked in. Debt growing faster than the capacity to service it is unsustainable, and unsustainable systems do not sustain. Something will break. But you can position yourself to survive the breaking and potentially thrive in what comes after. The system was built through design and evolution to extract maximum value from your lifetime of labor, to keep you in debt from age 18 until death, to transfer wealth from workers to creditors, from the present to the past, from the many to the few. But knowing this gives you power. The power to see the trap, the power to understand its mechanisms, the power to make different choices, not choices that escape the trap entirely, because that is nearly impossible, but choices that minimize your vulnerability and maximize your resilience when the trap finally springs shut. They built a system you cannot fully escape, but you can see it clearly now, and seeing clearly is the first step to surviving it. The trap is real, the architects are identifiable, the mechanisms are documented, the mathematics are unsustainable, the endgame is approaching. And you, now, at least know what you are up against.